Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg. And as we continue to navigate this uncertain world with our search for certainty, it's the Australian equity markets which are moving towards the 9 month high. Or it's not, rather, I'd say it's not just the Australian equity markets, but even the euro and GBP are near the 9 month high against the dollar. So it seems that a lot of major currencies across have found some strength against the dollar, but it's the next week central bank action which seems to bring about some sort of difference or change in direction, if there has to be any or any further changes in the market. So, GK, I'd like to get your opinion on what's the action ahead in the financial markets, as we see Japanese central bank has already taken the central stage for all the actions.
Yeah, good morning. Yeah, I think last 1 year we have seen a lot of attention on FX. It was initially the period of dollar strength, which started creating a lot of negativism for other markets, including stocks and bonds, as well as outflows. Some of the weaker EM countries faced extreme difficulties, but that now is changed into the other side. Like dollar has been falling consistently almost every day, and we have seen the dollar index lose nearly 11% from the peak of 114.78. And within the dollar, of course, we have euro and yen, which are really the main focus. Euro is the big fall in gas prices, milder winter, and a hawkish ECB are really pushing the euro towards the bigger resistances of 1.0950 and maybe beyond, depending on how the upcoming data from US pans out, as well as the FOMC speak as well. But on European officials are not giving up their hawkish stance. Lagarde, as well as Klaus Knot, of ECB member from Netherlands, was very vocal on Sunday that there will be a 50 basis points hike in February and possibly one in March as well. So the bellwether of FX is definitely leading the pack. Interesting, two schools of thought on Japan policy and the consequent yen direction. Some believe a change in the policy to more tightness and higher yield limit is inevitable, but others see it differently, because eventually, when the world is getting into a deflationary situation, the Japan inflation also might then start down, and Japanese may well hold on to their current policy of easing. In fact, other than the inflation, if you look at their machinery orders or industrial production, they were all substantially down. So at least till Kuroda leaves the his office, don't expect any major change in the policy. In fact, there is also speculation about who will become the next chief of BOJ. In the meantime, I expect the Japanese yen to trade with a slight strengthening bias, but unlikely that we break 127 on the downside and 132 on the upside. We should be seeing swings on both sides. So while on the dollar, we have to see and be aware that Fed officials continue to sound cautious about inflation and the rate hike path. And we had two members, the Valor, and also Mr. Jar. These are the Fed members who are continuing to talk about maintaining the current stance up to the rates reach beyond 5%. But there was one hint saying that the rates may be already reaching restrictive territory. But nothing new for the dollar, because dollar has already fallen. So there's no major reaction now. More movement on the dollar is happening because it's a trend, and the technical followers just latch on to the trend. So the February hike of 0.25 is a done deal. It's reasonable to question whether Fed's projection of another 0.5% point after that will hold, but the financial markets don't believe it, and they think that the 4.80 is the top, and the second half of this year we'll see cut as well. I think in between serious recession and a mild recession, another view that is emerging is there may not be a recession, but there may just disinflation. But this is all evolving theories, and we need to watch what's going to happen. And on the debt ceiling side, there is some negotiation that's happening between the Treasury Secretary and a bipartisan leader, but I think it's going to be a long drawn process because it is beset with a lot of political agenda. Therefore, I think US will be seen in a negative with a negative eye until this is unless this is resolved very fast. Slightly on the negative side, China reported nearly 13,000 COVID deaths in the last 1 week, and top officials have said that vast majority of the population has already been infected by the virus. So this can be seen in two ways. Most majority of the people infected and then free to travel, particularly in this week of holidays, will be a threat for spreading the virus. But otherwise, if most majority is already infected, that means peak has been seen. So really, it's a matter of waiting and seeing how this thing goes about on the Chinese side. On the Indian rupee, after weeks of decoupling from dollar index, rupee is now broadly tracking the dollar's fortunes, and the current strength is the result of it. Of course, the flows that are being mentioned are not getting fully absorbed, and therefore we have the rupee strengthening on a mild basis along with the dollar index. Unlike in the previous occasions, market is not buying dollars just because RBI has been there with the bids. That said, as I said earlier, we are nearing an important level of 80-50, which is likely to see a longer pause in the trend, if not a reversal. And the market remains focused on budget and then the FOMC, which can be a potential to trigger a corrective up move. And if there is a corrective up move, it should be well resisted at 81.50. Of course, we also have PCE core inflation and GDP numbers from US, which will be watched in the coming days. Other than that, we do not have any major data. This week, we have initial survey of S&P Global on the manufacturing and services activity in the major countries. On the RBI side, reserves were higher by more than 10 billion, and that was mostly due to the revaluation of foreign currency assets. Quite understandable because of the way various currencies and the relative asset values have moved. The yields are down, so you will have a upward valuation of RBS assets held abroad, and of course gold has also moved up. So all in all, I think we look forward to another week of weakness in the dollar, including against the INR, but probably the momentum is definitely slowing down as we head into the big events. Just to point out that China is on a holiday for 5 days, so volatility likely to be less in Asian time. Thank you.
Okay, JK, that was quite good. And yes, folks, there can be reduced volatility as one of the major Asian markets is out on holiday. But if we have to talk about Asian markets, how can we not miss out talking about the budget that we are expecting on the 1st of Feb next week. And with budget, we are also seeing the change in, correlation of INR with respect to the movement of DXY, and as INR joins the pack in the move of dollar weakness, we have seen quite a bit of strength for INR, and it seems that the momentum, if reduces, we can have a pause, as JK mentioned, around 80-50 regions. And why not? Because the fundamentals are also supportive with the increase in FX reserves and regular actions by the central bank. On the other hand, yes, we are also seeing euro leading the pack for the dollar weakness, as we see GBP, Australian dollar, and rest of the currency following it. But on the Japanese front, as JK mentioned, there is good likelihood that there will be no major changes in the policy till we see Kuroda signing off, and probably a change in stance or any different action by the BOJ only when we see a successor coming in. So that's that for the time being, folks. We shall come back again tomorrow with another round of update. Thank you so much for listening.